Hello everyone and welcome back to another episode of what's going on in the real estate market in the southeast Wisconsin area. So let's start off with our recession watch. So the big one with that is the Wall Street Journal. They did a poll of both business and academic economists, and what they found was that these economists, they lowered their expectation of a recession occurring within the next year from 54% just in July to 48%. You might be thinking, well, that's really not much, but below 50%, we haven't seen that kind of optimism since about mid last year. So that does bode well, especially going into these winter months when a lot of industries, especially real estate, tend to slow down. And this optimism is being fueled by lower inflation, a really strong labor market, and economic growth that has really outperformed the expectations of these economists. So great job, USA. And that's actually really good considering where we are right now with the 30-year fixed mortgage rate. So this graph is from the St. Louis Federal Reserve, and it shows that as of October 19th, we are up at 7.63 for the 30-year fixed mortgage rates. According to other sources, mortgage rates for some people are going above the 8% mark. We haven't seen mortgage rates this high since early 2000s. So it's been a little over 20 years since we've seen these high rates. And this particular graph captures the impact of those rates in really a nutshell. So it goes from the light colors to dark colors. The light colors is the median existing home prices. As you can see, the past couple of years, we have been very dark colors, meaning very high median existing home sales. And the height of it actually shows the number of home sales. As you can see, we have a almost 20-year low in the number of home sales. We haven't seen lows like these since really the housing crisis, and we have even less homes on sale since then because of the inventory shortage. The problem that these high prices are creating, it's not just an affordability issue. The bigger picture here is that these high prices are pushing out these first-time or starter home buyers out of the real estate market and into the rental space market, creating more rental demand. So what happens when demand increases for any products? Well, so do prices. And rental prices are a huge part of the U.S. consumer spending, and it's a large part of the inflation equation, which is going to make it very difficult to justify the Feds stopping or slowing their interest rate in hikes, much less considering to start to lower it. Now, some metropolitan areas that really built up their multifamily real estate, such as apartments or other multifamily types of homes, they might be able to absorb that influx of potential buyers into the rental space, but those smaller regional areas that didn't have that multi-building or multifamily construction boom, they're not going to have any place for these home buyers who turn into renters to go, creating that pent-up demand and keeping those prices high. So we're going to want to watch this very closely in different regions, especially our own. So the big question then is, when will the Feds start cutting the federal fund rate? Well, the Wall Street Journal polled those same economists, and the majority of them say about the second quarter of 2024, which is really on line with what I've been saying in these videos, that about mid next year, 2024, we hopefully should see some relief in the form of interest rate cuts by the Federal Reserve. Why do we care when the Feds lower the Fed fund rate? Well, according to the Wall Street Journal, about 61% of all homeowners who have an outstanding mortgage have sub 4% interest rates, meaning no one in their right mind, unless they absolutely must move, or they're putting a large down payment down to reduce that interest rate impact, no one's gonna trade their sub 4% interest rate for something between 7 to 8% because they're not gonna be able to afford as much, and it's gonna cost them more to borrow. So that's really constricting supply because it's reducing that turnover rate. And we're not going to see any alleviation of those supply issues from new housing construction. This graph shows the housing starts all the way back to the 2000s. And as you can see, we're still woefully below the historic average for housing starts. We've been woefully below since the housing crisis. We came up above it for just a minute or two, and we're back below it again. And that is across the nation. This is not just an issue in Wisconsin. This is an issue across the nation. So this particular graph shows the change in single family permits from January of August of last year to this year. And it shows that pretty much across the nation, single family home permits have declined. Moreover, we're not going to see any relief from the foreclosure market. This particular graph from CoreLogic shows that as far as foreclosures in terms of the second quarter, we are still at 0.3%. This graph from Atom Data shows Q3. We did blip up just a tad bit, but we're still at historical lows. We are not going to see an influx of foreclosures flooding the market like we did with the last housing crisis. These two graphs show the year-over-year change by state of home prices. The one on the left is July. The one on the right is August of this year. And as you can see, the year-over-year change of home prices in July was between 5 to 7%. In August, it shot up to a solid 7%. So that speaks to two things. One, the strength of the buyer demand, especially in the face of inflation. Also the strength of our real estate market. People are wondering, when are we going to see this crash? When are we going to see this huge correction? Really, we fundamentally can't, because we have these inventory issues. And as long as those inventory issues continue, we're going to still see these strong home prices. So really, what's going to have to happen to solve this affordability and inventory issue? Well, that's really a two-pronged approach. What's going to have to happen is the Federal Reserve, they're going to have to not only stabilize the Fed fund rate, but also lower it to make it more affordable for people to borrow the funds they need to afford that mortgage. The next thing that's going to have to happen is to have those supplies to build new construction of single family homes to become more affordable and more attainable, so that we see that boost in housing production. Because like I said, supply comes from two areas: people moving, selling their homes, and builders and developers building new construction. So we need those two things in order for the inventory and affordability issues to see any relief. All right, so let's start looking at right here in Southeast Wisconsin. This is days on market. As you can see, in August, we jumped from 40 to 60 in September. We are already going into that winter seasonality where demand is starting to wane. Now, here's where it's going to start diverging. If you've got a very well-maintained home that's reasonably fairly priced, your home is going to go very quickly. If you don't have that, you really want to start looking at your days on market and start getting realistic with your expectations and how that matches up with what's going on, and then what you really need as far as time frame and dollar amount. Because right now, according to the realtor.com, 18% of listings in September saw price reductions because their homes just sat on the market too long. So you're going to want to start consider having seller concessions or reducing your price if you want to move your property before we get into the full swing of the winter seasonality. Looking at the median home prices right here in Walworth County in September, the year to date, the median home price is $335,000. In Kenosha, it is $268,000. You can see from these two graphs, we are in the fourth consecutive month of seeing less new listings. So that means tighter inventories. We see active listings going up because the homes that haven't sold, they're just sitting on the market. Sales to list price ratio. So we are holding steady from August to September at about 96%. This is not likely to go above 100% as we go into these winter months. In fact, they're probably going to oscillate, dip between about 94 to 97%. Again, just because it's those winter months, this is when we see a lot more concessions. Again, unless you have a very well-maintained, well-priced home. Okay, so what does this mean? If you are a buyer and you see a very well-maintained, well-priced home that just came on the market, go see it quickly. And if you really like it, make an offer, make a strong offer. Likely there will be others, especially if it's well-maintained, well-priced. If you don't see that and it's been sitting on the market, that means you as a buyer have a lot more negotiating power, because the further into the winter months they're going to go, the longer it's going to sit on the market, the longer it's going to cost them, and the more price reductions they're going to have to do. Make it reasonable. Don't lowball, because what they'll do is they'll just reject your offer, maybe even take it off the market, and then relist it in the spring for the same, if not a higher price. Sellers, if you have a well-maintained home, give us a call. We will help you price it quickly. Pricing strategy is everything, especially in this market, if you want to get top dollar. If you don't have a well-maintained home, price it accordingly. Give us a call. We can help you with that. If you don't price it accordingly, you are going to sit and the market will force you to price that home properly. If you have the time and the funds to do some cosmetic upgrades or do some maintenance, repairs and upgrades, definitely get that done. Give us a call. We can help you decide what's going to give you the best return for your investment, because there are some investments in your home that you really don't want to make that's going to cost you more and not going to give you any recoup value. So let us help you with that. All right, in the meantime, if you have any questions, there's our contact information. Go ahead and click the subscribe button. Feel free to share this video if you think you have someone that might be interested. And thank you for stopping by. We'll see you next month.